So let's now look at specific ways of trading once you've identified a trend. So here we are. If you look at the chart of the XLE, we know that sometime last year, around June, July, it went down and then it's been down ever since. So if you come and look at the chart, that's somewhere right here. You don't have to get in right there at the top, but you could have sold the XLE. You can say, I want to sell 100 shares of the XLE at, let's say, what this price was, say 95. You don't have to catch the top, but once the trend is established, then you can sell at 95, and of course anywhere here you could have bought it back. So basically you would have been selling this short, and anywhere here once it's come down to 70, 60, wherever, that would have been a great trade if you had sold it at around 95 and bought it back at about 75. So that's a $20 profit right there per share. So you can imagine, so that will be about $2,000 profit. Now, how much would this trade have cost if it was at 95? Let's go see. Sell it at 95 would have been about 9,400. Okay, and if you had a $2,000 profit, you would have bought it back for 7,500. So that's the simplest way of taking advantage of the pattern that you see. The second way you can take advantage is you can go into the options market. You can buy a put option. Now on Thinkorswim, you're going to see this a little later, but let's say there's a feature called Think Back, and you can actually go back to a particular day right here. So if you come here and do the calendar, and let's say we went back till about July 31st, and you look at XLE, and it'll tell you on July 31st, these were the options that were at that time. So let's say you bought a Jan 2016. At that point, there would have been 168 days for this option to expire. But at that point, if you had bought a put option, say at the strike price of 60. Now, granted, you don't know how these options work at this point, but I'm just giving you an example. And if you look at this option itself, say 10 contracts on this, your profit today would have been 4,380. Basically, buying a put option is going bearish. Put options increase in value as the stock goes down. So you could have bought a put option also. Now, the other interesting trade that you can do with this kind of a scenario is that you know now the XLE is starting to underperform the S&P. So this is what I'm calling as the arbitrage trade, because this is a fairly safe trade because it makes it hedged. So what we are saying is, if you look at this chart, we are saying that the energy sector is going to underperform the S&P. So what we would do is we would sell the XLE and buy the SPY. So basically it would be two trades. Now granted, one of them would be a loser. So in this case, if you had bought the S&P, even now the S&P also has gone down. So this would have been a loser in your trade. However, this would have been a big winner. And so this is what you call an arbitrage trade, where you're taking advantage of the relative weakness or the relative strength of one sector against the S&P. Similarly, if you were to go look at, let's say, XLF, you wanted to take advantage of an arbitrage situation in the financials, especially when it's going up. Here you can see the financials are outperforming the S&P. So in this case, you would buy the XLF and sell the spider. So one of them will be a winner, one of them will be a loser, but the winner will more than make up for the loser. And that's the whole idea of an arbitrage trade. So these are three trades that you can do whenever you see a sectoral rotation happening. Once we get to the section on options, you're going to see how you can use put options or call options to actually get a much larger profit on your capital. Options have leverage. They're a leveraged instrument. So there's three types of trades you can do. Once again, to just recap, you can go ahead and sell the XLE itself if you know that it's going to go into a bearish pattern. The second thing you can do, you can buy put options on the XLE. And the third you can do is just create an arbitrage trade where against the SPY itself, so that you're somewhat hedged in this particular trade. Your profit won't be as much as the other two. However, it's a safe way of playing this arbitrage trade. So hopefully this has been helpful. That's the end of this ETF section. As you can see, it's a very fascinating instrument. There is so much variety. There is so much flexibility. You really can use ETFs itself as a starting point to start investments and trading. Now, what I do want to do is we have a trade here, should get executed tomorrow, depending on how much this ETF moves, and track those trades through this course. Thank you.